What determines the success of any business? There could be multiple answers, but the most important thing is your ability to make the right decision at the right time. So the important question is, how can you make the right decision at the right time? For that, you need to understand your business metrics. So in this video, we are going to explore the important business metrics for a SaaS company. And welcome to the 3 Club. If you are an entrepreneur or a manager, you already know the importance of measuring your business metrics. As you already know, business metrics evaluate the success of any particular activity, whether it's a marketing or a sales campaign. These business metrics are also known as key performance indicators, or KPIs. There are hundreds of different KPIs, but in this video, we are going to discuss some important SaaS KPIs. And these KPIs become important once you figure out a perfect product market fit. So finding a good product market fit is the first thing you need to figure out before these metrics become important. And once you found that product market fit, then these metrics become important. Now let's look into these metrics. One of the initial metrics you need to know is your conversion rate. Conversion rate is the number of people who are coming to your website, and how many of them are turning into trial or demo leads. So if 1,000 people are coming to your website, and if you're converting 10% of them into a trial or demo leads, which is a pretty good number, then you have 100 trial or demo leads. That's one conversion rate, and of course you can have conversion rates for various different things. Out of these trial or demo leads, if you're converting 10% of them into paying customers, then you have 10 customers who are going to buy your product. But what this means? Out of your website visitors, essentially 1% of them are turning into paying customers. Or your conversion rate from website visitor to paying customer is 1%. And from trial to paying customer conversion rate is 10%. This is often referred to as a conversion funnel. This funnel determines the number of customers visiting your website, from which how many of them are signing up for a demo, and from which how many of them are actually turning into paying customers. So the way you determine what your conversion rate is just by dividing the number of paying customers by the number of leads. In our example, we have a conversion rate of 1% from website visitors to paying customers. The next metric is the monthly recurring revenue, or MRR. This is probably the most important measure of a SaaS company's success. What that means is that, if you have a customer who is paying you $100 per month, then your MRR is $100 per month. But the MRR calculation gets complicated when you have some customers who are paying you upfront on an annual basis. So let's say on a given month you have 2 customers. One of them signs up for a $100 monthly account and the other one signs up for a $1,000 annual account and pays you upfront. So your revenues that month, or the cash coming in, was $1,100. But your MRR from that second one is actually $83 per month for the next 12 months. So that's how MRR is calculated. So in this scenario, that $1,000 per year customer is actually worth $83 in MRR. So your total MRR is $183 in this scenario. The growth in MRR is what a lot of potential investors are going to care about before investing in your company. The next metric is annual recurring revenue, or ARR. Basically, ARR is your monthly recurring revenue multiplied by 12. So in this example, we have $183 in MRR multiplied by 12, and we have $2,200 in ARR. So in our 2 customers example, one of them was paying $1,000 per year. The other one was paying $100 per month. And after a year they are going to pay us $1,200. So you add $1,000 and $1,200. And that's where the $2,200 ARR comes from. ARR is a key metric which investors use during the valuation of a company. If you have $100 million in ARR, then usually investors give you $1 billion valuation. So hitting $100 million in ARR is the criteria for a SaaS company to join the Unicorn Club. The next metric is known as average revenue per user, or ARPU. The way you determine what your ARPU is just by dividing the MRR by the number of paying customers. In our example, you have $183 in MRR divided by 2. So you have an ARPU of $92 per month per customer. Since you know the ARPU of your business, now you need to know how much is an average new customer worth to your business. This is known as customer lifetime value, or CLV. This is an important metric to know, because knowing your CLV will help you in determining how much you should spend on acquiring a new customer. And the CLV can be calculated by multiplying the ARPU by the number of months our average customer remains as a customer. Now the key question is, how do you know how many months your average customer remains as a customer? Unfortunately for startups, that's virtually impossible to know. But once you have enough significant data, you can actually calculate them. And the way you do that calculation is called attrition rate, or churn rate. To calculate the attrition rate, you take the total number of cancellations that you get in a given month, divided by the total number of customers that you have. Let's say on a given month you have 1,000 customers, and if you have 50 cancellations out of 1,000 customers, then your attrition rate or churn rate is 5%. Knowing that you are losing 5% of your customers every month, then your average customer is going to remain with you for approximately 20 months. So how to calculate how many months your average customer remains as a customer? It's 100% divided by your attrition rate or churn rate in percentage. Here it's 100% divided by 5% to get 20 months. So now all of a sudden it becomes super easy to determine what your customer lifetime value is based on your attrition rate. So your CLV is $92 of MRR, multiplied by the number of months your average customer remains as a customer with you, which is 20 months. In our example, this is going to be $1,833. So why is CLV so important? Because based on this amount, you can determine the amount that you can spend to acquire a new customer. So the question is, what is the amount that we should be able to spend if you have a CLV of $1,833? And the answer is you have to figure out your customer acquisition cost, or CAC. The way you determine what your CAC is by dividing the total cost of sales and marketing by the total number of new customers that you're acquiring with what you spend. And the total cost of sales and marketing is the sum of all the activities you do. That include advertising, attending conferences, and other similar expenses. Let's say if you are spending $50,000 per month, and within that time frame, you are acquiring 100 new customers. So your CAC is $500 per customer. So if you have a CAC of $500, and if your CLV is $1,833, then your CLV to CAC ratio is 3.66. Any number which is greater than 3 for this ratio is pretty good, and you should always keep this ratio above 3 for a successful SaaS company. That's it for now, and please let me know if this video was useful for you in the comment section below. Currently, we are working on other videos related to SaaS. So please subscribe to our YouTube channel, or follow us on LinkedIn or Facebook for the upcoming videos. And if you learned something from this video, then please hit the like button. I will see you in another video. Until then, bye.